Hi, Andrew Cooper here, Advice for Living Financial Planning. I know I've done a video already this month, but there's been a couple of things that have happened that have suggested to me that maybe I need to do another. So, 4 things to talk about today. I've actually got a list, so I will have to look away. First off, insurance premiums. Secondly, age pension. Third is a bit of a market update. And fourth, I wanted to talk about some forms that we've been sending out to people. So first off, insurance premiums. Those of you who are with us that have got life insurance, in particular in income protection, will have noticed that premiums have been going up. This has been largely forced by the government. 2 things are happening. One is that the government has said that insurance premiums need to be sustainable. They want to make sure that if you need to make a claim, the insurance company is not going to go belly up. And insurance companies have been going, really there's been a bit of a race to the bottom in terms of premiums, so that's going to affect it. The second thing is the government has forced the insurers to make a change to income protection. What will happen is, as of basically next Monday, income protection will be harder to get, and the policies will be inferior to what exists at the moment. So it's going to be one of those difficult things. If you've got income protection at the moment, I would be, and you still need it, I would be very reluctant to let it go. At the moment, you can insure for 70% of your income plus superannuation and stuff like that. That's going to drop back to 60%, and then over time it will be actually less than that, so the policies will not be as good. The downside of it is that your premiums hopefully have had their big jump and hopefully will be more sustainable. The insurers are saying they're wanting to have insurance policies be more sustainable now, so hopefully that will be okay. Policies will still be available, but as I say, they won't be as good. So hopefully, as I say, if you've copped that big increase and you can sustain it, then that hopefully will be the worst that you'll get. So that's that. Again, any questions on that, please talk with us. Secondly, age pension. Many of you will be aware age pensions have gone up and have taken and have had a fairly decent sort of a bump for a range of reasons. There's been a little bit of inflation around, which has forced things up. So new age pensions for singles now, $967.50 a fortnight. For couples, maximum pension is $729.30 each per fortnight, and combined with that, the thresholds and cutouts have gone up. So for a couple now, you can have as much as $891,500 in assets, not including your house, and you will still get some pension. The threshold for couples is now $405,000, so up to $405,000 you get full pension. For singles, it's $270,500 and you still get full pension. And for singles, the cutout is now $593,000. So that's been quite a substantial increase in the threshold, and also a decent whack in terms of pension, about $20 a fortnight. On the other side, of course, those of you that have got superannuation will have noted you have probably had fairly substantial increases in the balance of your portfolios this year, so you may not be getting much or any of that increase, unfortunately. As they say, you know, the government giveth and the government taketh away. So that's the story on age pensions. Markets, again, still a very weird time for markets. The most notable thing that's been on the news that probably a lot of you will have seen is that iron ore prices have decreased by about 50% since early this year. That, I will say, that is on the back of an increase of something like 200% last year. So prices have come back, but they certainly went through a big increase last year. There is some expectation that prices will ease even further. The good thing for Australia is that we are quite a low-cost producer, so there will be other producers around the world who will basically go out of production before Australia does. So from that point of view, it's good. Now, the primary reason for it is that the Chinese are not buying as much iron ore, and the reason they're not doing that is because they have a property glut. They have the dual problems in that there is an enormous amount of excess property stock, apartments predominantly in China, and also they've got the problem is the prices are really high, and so first home buyers are not able to get into the market. The Chinese government has decided to take a stand on that in a typically heavy-handed way, the way they do. And so, they've basically stopped new construction has basically stopped. There has been an enormous amount of speculative home building in China, and the government's basically put a stop to it. They've done that in a range of ways. Finance is harder to get. There's all sorts of new regulations. And so what they're looking to do is to try and soak up that excess stock and also get prices down. So as a result of that, they're not buying iron ore, which of course they turn into steel, which they use to build apartment blocks. So that's the way it goes. That could be an extended issue. So the impact of that on Australian share markets and therefore on your investments and so forth is that it is very, very likely that the Australian share market will ease. Now, of course, iron ore is only one part of the market, but the thing is, it's a fairly decent chunk of our Australian market. Our market is basically banks and iron ore, or banks and mining, but predominantly iron ore. And so what that's going to mean is that we will see our share market come back. Now, should we be running for the exit? The thing to remember, of course, is that unlike most places around the world, Australian shares pay generally quite good dividends. You're still looking at dividends of somewhere around the 4 to 5% mark, which is better than what you're getting in the bank. So it's like, now values may slide, and so as long as people that are retired, as long as we're working out of cash, then we'll just need to ride that out. I wouldn't be. As I say, I'm not expecting there'll be a run. I'm not expecting a huge crash. Hopefully there'll just be an easing, but it's likely there will be a correction. So be prepared for that. We've had tremendous growth over the last 12 months. Many of you have had growth in your portfolios of upwards of 20%. I mean, that's an enormous increase. So unfortunately, some of that is probably going to come back. The things we're doing is that as people are coming up for reviews, we've been looking to move you out into what's called unhedged international shares, which means that the share, they're in Australian dollars. The other part of the equation is that it's likely we will see a reduction in the value of the Australian dollar. Now, in terms of being invested in international shares, that's actually a good thing, because as our value goes down, the value of those international shares goes up. So that will hopefully compensate for any adjustments in the Australian share market. So we're looking to do that. Also, of course, we have been moving people out of global property and into infrastructure, which also looks like an asset class which is going to go quite well. So those are the two things we've been doing to hopefully cope with what's been going on. We can't control all aspects of the market, obviously, but we're doing what we can to minimise the damage. And so that's about it for markets, I think. The last thing, and I wanted to leave this to last and emphasise it, because of some changes yet more changes to regulations the government has making, we are having to mail out yet another form for you to agree to and acknowledge fees that we charge for the service we provide. I can't overemphasize the importance of that, of those forms. If we send you that, and we're mailing those forms predominantly, so if we mail you one of those forms, and you're happy to continue with us, can I please ask you to sign those forms as quickly as possible and mail them back to us? The government has imposed a time limit on when we have to get them back and then lodge them with the superannuation or investment company that you're with. And if we don't meet that time frame, then effectively what we have to do is we're basically cutting off from you. It stops us being your advisor. So I think the government is now beginning to realise that maybe it was a bad move, but it's only recently started, and so nothing's going to happen for the next couple of years. So, as I say, if we mail you one of those forms, can we ask you please sign it as soon as possible and mail it back to us so that we can so that we can get it lodged with the fund before the cut-off time. Otherwise, they will simply turn off the fees, and basically we won't be your advisor anymore. So that's it. I'm sorry that's gone for a bit longer than normal, but there was a bit to do. As usual, any questions, do please give us a call or send us an email. Yeah, let's just keep making the best of it. Although I did hear yesterday that apparently Chairman Dan has said that once we all get to 90% vaccination, there'll be no more earthquakes. So that's good to know. So anyway, have a great day. Let's all get out of lockdown as soon as we can. Thanks.